Okay, so hi everyone. My name is Allison. I am an SRA Hub advisor. Today we're going to be talking about credit cards and credit scores, which is something that many adults use. And so I hope that you find this helpful as you're learning more about or trying to be more proficient in financial literacy. So what I'm going to go ahead and do is share my screen. Oops. Okay. And if any of you have any questions, feel free to type them in the chat box and then I'll answer them at the end. But make sure, you type it in, don't use the raise hand feature. Okay, so first of all, what are credit cards? So credit cards allow you to spend money you do not or may not have. You can get them through banks and credit card companies, and they will loan you money. So essentially, every time that you swipe your card or you use it somewhere, you are receiving a loan, very similar to like your student loans, and you're expected to pay all of it back. And a lot of the credit card companies you guys have heard of, like Discover, Visa, MasterCard, American Express, all of those guys. Okay, so tips for managing credit cards. So you never want to spend more than you have. I think that's one of the biggest traps of credit cards, especially with students or people who have just gotten them for the first time. People often spend more than their means, which is really bad. You definitely want to pay the bill off in full every single month, and you want to pay your bill on time consistently. You don't want to open up more credit cards than you need, and then you don't want to sign up for credit cards just because you were pre-approved or because they are offering something free. Oftentimes, usually in the beginning of the school year, you have these big like events where there's a lot of like companies who are giving away free stuff. And so usually at those types of events, there might be some credit card companies out there who are trying to lure students in by offering free stuff to get them to apply for the credit card. So don't fall for those traps. And then you want to avoid signing up for credit cards at stores just for their discounts. So basically, in sum, credit cards are a way of receiving loans from the bank, and then you can pay off that loan later in the month. And the reason why credit cards are a lot more appealing than debit cards. Oftentimes, credit cards have some sort of reward associated with them. So that's why a lot of people like to use credit cards. So for example, you might be able to get like 2% back on all of the purchases that you make. So whenever you use your card to pay for something, you'll get some money back because of that purchase. Or it might be in the form of points. So certain cards will have different multipliers for points. So they'll have like, receive 3 times the points on dining purchases. So whenever you go to like a fast food restaurant or a regular restaurant and you swipe your card, you're going to get a bunch of points from it. And those points can be used for a lot of different things. So you can use them to redeem for cash, so you can get cash back. You can use them to redeem for gift cards. You can use them for travel. Sometimes you can use points to pay for flights or for hotels or for a bunch of different things. So those rewards are really the real reason why people like to use credit cards over debit cards. Okay, so now we're going to talk a little bit about the credit card dilemma and a little bit about debt. So this is the first scenario. So let's say you charge $2,500 to your card and you only pay $50 a month. If your yearly interest rate is 19.9% back, how long will it take to pay off the balance? So mind you, $50 each month out of $2,500, that's a really, really big gap. So I'm anticipating that this is going to be a very long time. And so 9 years and 1 month is what it's going to take to pay it off. And because of that extra interest, which the interest is basically extra money that you owe because you're borrowing money that you haven't paid back yet. So same thing with student loans too, right? Like depending on how much you haven't paid back yet, that's how much interest you're going to accrue. Same thing applies for credit cards. So even though you only started off borrowing $2,500, because it took you such a long time to pay it off, you end up paying $5,450 instead. So that's why it's really, really important that you try to pay off your bill as much as possible. In an ideal world, you want to pay the whole thing off, but if you can't pay the whole thing off, you want to pay off as close as you can to that full balance. Okay, so let's look at scenario number 2. So this one is the same thing. So you're also charging $2,500 to your card, but this time you're paying double. So you're paying $100 per month, and your yearly interest rate is 19.9%, which is the same percentage as the last scenario. So for this one, just paying double or paying $100 more, you pay a significantly less amount in the long run, and it's also going to take you a much shorter amount of time to pay it off. So that last one said 9 years. This one is 2 years and 9 months, which is still a long time, but definitely that, gap of 6 to 7 years is obviously very significant, and you're also paying like $2,000 less. So that's why it's really important that you try to pay your bill as close to the full balance as possible on time every single time you use your card. Okay, so let's get into what credit is in general. So not specifically credit cards, but just credit in general. So your credit score is your financial reputation, and it shows how responsible you are, but more specifically, how responsible of a money borrower that you are. And it's a score between 0 and 850. So if you don't pay your credit card bill on time, your lender can report you and you will have a poor credit score. So in the example that we just saw, that person who charged $2,500 and was only paying $50 or $100 a month at a time to pay it off, they would likely have a very poor credit score because they're not paying it off very well. And if you have a poor credit score, that usually means that you're not paying your rent, or you're not making your student loan payments on time, your car payments are late, medical bills are late, and that can also impact your credit score and your financial reputation. So all in all, your credit score is affected not just by your credit cards, it's affected by all of your financial decisions. So if you don't pay your rent, not only can you get potentially evicted, but your credit score can also go down, and we'll talk about this a little bit later. That can also affect you being able to get approved for an apartment. Student loan payments, if you don't make those on time, that can also make your credit score go down. And any sort of bill or debt that you have, if you don't pay that off on time, that will decrease your credit score too. Okay, so a bad credit score means you cannot be trusted with borrowed money, which is what I just explained. So you will have a hard time opening new credit cards, renting an apartment, getting a car, buying a house, getting loans, et cetera, et cetera, et cetera. So when you have a bad credit score, people do not like to give money to you, obviously, because that shows that you are not very financially responsible. So let's say if you want to have those really nice rewards that some credit cards have, you won't be approved for them if you have a bad credit score. If you want to rent an apartment, you're going to have a hard time doing that because the landlord's going to see that, this person's not financially responsible, so I don't know if they're going to be paying their rent on time every single month. If you want to get a car, that usually involves, having some sort of loan associated with it. And so if you do get a car and if you decide to purchase a car, then your loan amount might be, or your interest rate might be really high because they see you as someone who's very risky. And same thing with buying a house and getting loans, your interest rates will just be really high when it comes to, if you get a loan for anything or for your mortgage, if you're buying a house. Okay, so you can check your credit report once a year for free online, and checking your credit report is different than checking your credit score. Many banks let you check your credit score for free. I know a lot of people like to check their credit score pretty frequently, like once a week, just to see what their score is. And then your credit score shows your full borrowing history. It can help identify if you have if you have forgotten debts or if your identity has been stolen. So it's really important that you check your credit report every single year, just so you can see that, like the slide says, your identity hasn't been stolen, or there's no discrepancies when it comes to all of, your money flow. And the reason why it's important to check that is because you want to make sure that everything is in check, right? Because if you don't check that, then you have no idea if all of your money is in check, right? Like you want to make sure that all of, you keep tabs on all of your money, and that everything that should be there is there. When it comes to your credit score, you can check it all the time for free. There's some websites out there like Credit Karma or NerdWallet. That's another good website too, where you can check your credit score. And we'll also talk about a little bit about what the numbers mean when it comes to credit scores. Okay, so this is basically a little infographic into what it means to have a certain credit score, right? So, like I said earlier, your credit score is from 0 to 850. So basically anything less than 579, lenders see you as a very risky borrower. So if you have a low credit score, which is 579 or less, then it might be really hard for you to rent an apartment or to get a car or to actually nowadays I've even heard that it might be hard to even get cable if you want to get cable at your house or your apartment, or even to sign up for a cell phone plan. They check credit now. So it's very, very hard to get far in life if you have a very bad credit score, as you guys can tell. Moving on, 580 to 669. Some lenders will approve loans with this score, although I will say in my opinion, that's still a little bit low. 670 to 739. Most lenders consider this a good score. And then anything more than that is basically you're in pretty good shape. So also with credit scores, you guys can look up like what it means, but there's a certain way that your score is determined, and there's a lot of crunching numbers that go behind it. So some things that it calculates is like your average number of accounts. So how many, so an account is basically any sort of like debt that you owe, or any like bank account that you owe, right? So your student loans, each student loan that you took out, that's like an account. Your checking account, savings accounts, all of your credit cards, those are all accounts. And then it takes into consideration like how much credit you have. So if you have credit cards, what's your credit limit? If you have a really high credit limit, what is your ratio between how much money you actually use on your credit cards versus your credit limit? Because if you're spending close to your credit limit, then that's also not good, right? Because lenders see that as like, oh, they're kind of cutting it close, like they're using as much money as we're offering them. So you always kind of want to or when you use your credit card, you want to make sure that you're not trying to reach your credit limit. And there's a bunch of other tips and stuff that you guys can look up on your own, but there's lots of ways, or there's a very calculated way that your credit score is calculated. So you can look that up on your own time. But I will say, for a lot of these things, you can't really change it because the only thing that will change your score is time, right? Like one of the factors in figuring out your credit score is your average age of accounts. So let's say you're in college, or I don't know, some of you might still be in high school. Obviously, if you open an account, the average age of your account is going to be very low because you just opened it. Whereas people who have had, people who are much older might have had credit cards for like 30, 40 years. So their credit score is much higher because that's a determining factor of their credit score. So yeah, feel free to do your own research. But yeah, that's credit scores in a nutshell. And you want to establish good credit by paying your bills on time and keeping your balances low. Don't borrow more than you can repay. So that's just a little summary of everything that I kind of talked about. You want to have good credit because having good credit can take you very far in life. Like you'll have a much easier time once you graduate from college if you have a really good credit score. So yeah, if you guys are in college right now, I highly suggest that you look into getting a credit card, because that can potentially help you, if you're trying to relocate after college, that'll help you, get approved for an apartment, or you might be able to, do all sorts of things. So if you want to, do some preliminary research around credit cards right now as a college student, highly suggest that you do so you're in good hands once you graduate. So that is the end of the presentation, but let me, we have one question. Do we still get credit if we missed the pre-pool? I joined over phone before I joined on my computer. You will still get credit if you missed the pre-pool, so don't worry. And then does paying rent on an apartment build credit? Yes, it does. So if you're consistently paying on time, that'll help you build your credit. Yeah. If you guys have any other questions, feel free to type them in. But in the meantime, I'm going to launch the post poll. So it should pop up on your screen right now. And again, if you guys have any questions about credit cards, feel free to put them in the chat box, or if you think of something after this webinar is over, you can always post on the Hub. So we have a couple of questions. Even if it's an on-campus apartment, yeah, any apartment building where you have to pay rent, then yeah, that will help you build your credit. If we have a credit score from a loan but no credit history, will companies take that into consideration? If you have a credit score from a loan but no credit history. Okay, that's a little confusing. So you don't get a credit score from a loan. Your credit score is the result of a bunch of different things. Like if you have student loans, that's one part of it. But yeah, there's many different ways to get a credit score. So I'm a little confused. And I'm not totally sure what companies you're talking about. So if you can clarify, then I might be able to answer. My landlord told me there's no way to track who's paying. I'm not totally sure about that. I don't know, that might just be your landlord. But I think what's more important is I think a lot of people, so I don't think that paying your rent to an apartment necessarily helps you build credit, like, but if you get evicted, that will definitely affect your credit, because they'll see that you don't have like a consistent amount going towards rent every single month, if that makes sense. What if you don't use a credit card to pay for anything? Do you still build credit? What if you pay with things with a debit card? So with a debit card, I'm sure a lot of you guys have debit cards since you're in college. You do not build credit if you don't, sorry, let me rephrase that. You won't build credit if you use your debit card, because it's a debit card. So it's like whatever money that you have in your account, that's the money that's being taken out when you swipe your debit card. So if you want to build credit, you have to use a credit card. What if you don't use a credit card to pay for anything? So if you don't have a credit card, I suggest just doing your research and finding like a starter credit card. Oftentimes they don't have like any rewards associated with them, but they're designed to help you build your credit so you can get like, higher level credit cards. What credit card company did you choose? So I'm not going to talk about my own credit cards, but just do your research. Like a lot of banks that offer checking accounts have credit cards too, like Chase, Wells Fargo, Bank of America. They all have credit cards. Could I build my credit by investing, or does it not count? That is a great question. So yes, investing will definitely affect your credit score. I'm personally not super familiar with investing, but yeah, since that's a form of like of income, that will definitely affect your credit. What rate should I get my first credit card? Most of the time the rates are crazy high. Yeah, so that's a good point. So yeah, usually the rate is going to be very high for first-time credit card holders, and that's just because you don't have any credit history, right? So they don't know whether to trust you, or they don't trust you inherently because they don't know what type of borrower you are. You know, you don't have any history in regards to like on-time payments and stuff. So whenever you get a credit card for the first time, the interest rate's just going to be high. But hopefully when you open up future ones, it can come down. Yeah, any other questions? Not everyone has finished the post poll, by the way. I'll give you guys like 45 more seconds to do the post poll. If your credit limit is on 1,000 and we can pay it off, is it safe to spend that amount and we pay it off gradually, or would using that amount hurt? So in my opinion, if your credit limit is $1,000, I would not spend more than 30% of that. That's usually the percentage a lot of people say to stay below. So, and the reason being is like what I said before, if the credit card company sees that, or any lender is seeing that you're spending close to your credit limit, they see that as you're trying to like max out your credit card, right? Like you're trying to borrow a lot of money that you don't have. And so you want to keep that ratio pretty small. So try to spend less than 30% of your credit limit. And then, you know, obviously the smaller that it is, the more likely that you are to pay it off. So going back to your question, if our credit limit is $1,000 and we can pay it off, is it safe to spend that amount and pay it off gradually, or would using that amount hurt? So I would not advise you to spend all $1,000 of your credit limit, especially if you're just starting out. I would only spend like less than $300 of it every month, and then make sure you pay it off in full every single month. Yeah. Anyone else? Okay, so I think that's the end of the webinar. I'm going to go ahead and end the poll. So a lot of people asked a lot of really, really great questions, and I'm really happy about that. If you guys have any more questions, feel free to post them on the hub or email us. I know that was a very, very quick presentation about credit cards, but if you guys do your own research, there's a ton of information out there. You know, there's a lot of things that I didn't even cover in this presentation, so I would make sure that you do your research thoroughly before you sign up for anything. But I definitely think credit cards are a really great tool that you can take advantage of, especially as college students, because I didn't get my first credit card until like the end of my senior year of college, and I really wish that I had gotten it sooner, just so I had more credit built up. So yeah, just, if you sign up for one, just make sure that you're being financially responsible with it. And of course, if you guys have any other questions, feel free to email us at the hub or post on the hub, and we'd be more than happy to help you. Yeah, so thanks guys. I think that's going to end the webinar today, and I'll see you on the hub. Thanks everyone.